Hello, everyone, and welcome to the final webinar in Fasken's 2023 Quarterly Perspectives on Tax Series, Tax Considerations for Indigenous Equity. We are pleased to be presenting today from Treaty 7 territory in our new office on Tsuut'ina Nation. This is also part of the Taza Development Project, which is one of the largest First Nation development projects in North America. It comprises 1,200 acres and has 3 separate villages. Taza and Dene means something wondrous is coming. So my name is Bokenfohr. I'm a partner in the tax practice at Fasken based in Calgary. I specialize in complex tax matters across a broad spectrum, including business structuring, corporate reorganizations, pre-sale and divestiture planning, M&A, etc. I'm joined by my colleagues Ron Ezekiel and Zach Romano. Ron Ezekiel is based in Fasken's Vancouver office. He's both a partner and co-leader in the firm's Global Energy and Climate Group. His industry knowledge, ability to navigate complex negotiations, and broad business transaction background make him an ideal choice for counsel on projects and M&A transactions in the energy and natural resources sectors. Among other industry recognition, Ron was named in 2023 and in 2018 as Vancouver Energy Lawyer of the Year by Best Lawyers in Canada. Zach Romano is a partner in our Vancouver office. He is a corporate commercial lawyer who is part of Fasken's Mining Group, Indigenous Law Group, and Global Energy and Climate Group. Zach assists clients with a broad spectrum of project development matters. These include environmental approvals, consultation issues, acquisitions and divestitures of resource assets, and Indigenous equity participation transactions. He has a particular expertise negotiating and drafting agreements involving Indigenous nations, including impact benefit, joint venture, and other project-related agreements. So in today's session today, we are talking about tax issues in Indigenous equity investment, but it's necessary to do that in a historical and socioeconomic context. And my partner, Ron, will begin with that background.
Good afternoon, everyone. Thank you for joining us today. It's a pleasure to be here speaking to you on this important topic. I'd like to provide just a little bit of upfront context for the discussion today and also give you a little bit of data that we've managed to scrape from publicly available information around what's happening in the Indigenous equity space. Next slide, please. So to understand this, we've got to go back to the treaty and Aboriginal rights and title spectrum in Canada. We have 70 recognized treaties across the province. We have a number of modern treaties that have been negotiated, largely in the north, some in Quebec, some in BC as well. And then we have a number of active tables where modern treaties continue to be advanced. And all of that is must be viewed in the context of the constitutional protection that we have for Aboriginal rights and title and treaties. Next slide, please, which comes out of Section 35 of our Constitution. That's been supplemented recently by 2 pieces of legislation. In BC, we have the DRIPA, which is an act that largely tries to bring in UNDRIP, the UN Declaration of Rights of Indigenous Peoples, or the Declaration, into BC law. It is a work in progress. And then federally, we have an equivalent statute as well. And both of those are really driving forward the conversation on Indigenous equity, amongst other things. We have historically relied on case law and the obligation that case law creates for Crown decision makers to consult on decisions that impact Aboriginal rights and title. But we have new drivers in the marketplace, these pieces of legislation, and also we have drivers coming out of the financial markets and investors looking for ESG considerations and where they're putting their money, which are driving a lot of these conversations as well. Next slide, please. So this is really a story about economic reconciliation that actually originates in part from one of the Truth and Reconciliation Commission recommendations, 92.2, speaks about long-term benefits for Indigenous communities, for Aboriginals, were rising from projects. And this notion of Indigenous equity is really building on that, and it provides lots of opportunities for nation building and for an alignment of interests with proponents. It allows proponents to de-risk projects by aligning Aboriginal and Indigenous interests with the project, and it allows a bit of a broader spectrum of tools. Historically, we've been negotiating IBAs, and that is a pretty structure that is aligned fairly well with a project before it gets built. There have been some movement toward brownfield IBAs, or IBAs in the context of projects that need new government approvals, whether there's an amendment or an expansion. But Indigenous equity and the opportunity for Indigenous communities to participate in equity is also an excellent tool in the context of a brownfield project. And also for new projects as well, but it's more tools in the toolbox to align those interests. Next slide, please. So you'll have seen the news stories. There are countless of them. They're front page newspaper stories. The 7 pipelines for Enbridge, Indigenous groups in New Brunswick, the Ridley Terminal sale. Even Snoop Dogg was looking to bring Indigenous equity in when he made his bid for the Ottawa Senators. It is really a hot topic across the country. Next slide, please. So what I'd like to do is just spend a few moments with you on some data that we've scraped from publicly available information. I recognize up front that this is not a full news story. Many of the Indigenous equity transactions are not public, and we can't pull sort of a comprehensive, transparent set of data. But some interesting points of interest here, at least when we look at the types of projects that have attracted Indigenous equity investment, you'll see the vast majority of them are in the renewable energy space, wind, solar, hydro, with small percentages coming out of energy transmission, pipelines, natural gas projects. This is probably a historical perspective because, in part, this is driven, in our view, by the size of investments. Historically, Indigenous communities were making these investments off their own balance sheets. Maybe there was some carried right interest in there. Maybe they were earning in over the course of their project. It's a lot easier to do that when you're investing in a relatively smaller project, whether it's solar farm, wind farm. Of late, we've seen a change. We've seen some of these government programs that support Indigenous investment emerge. The Alberta Opportunities Corporation. We'll talk more about what the feds have announced in a few moments. But there are increasingly opportunities for Aboriginal groups and Indigenous groups to obtain financing opportunities for larger projects with government help. Aboriginal Loan Guarantee Program in Ontario as well. We fully expect to start seeing some of these metrics move because as it was easier to invest in private sector projects in a bilateral negotiation between proponent and Indigenous group, we're now seeing a lot of interest coming out of government. So utilities, linear projects, large value, higher value projects, but now with an opportunity for Indigenous groups to really access the capital necessary to make those kinds of large scale investments in the equity. Next slide, please. In terms of geographic spread, again, with available data, we're seeing a lot of projects in Ontario and BC. Those generally are the majority. And again, I think a lot of that's driven by the renewable energy investments. Many are coming out of the Ontario market, some in the BC market as well. But again, as those Indigenous financial opportunities expand across the country, and certainly with a federal program, we're going to see those numbers change and probably a more rebalancing. So there are opportunities spread better across the entire country. Next slide, please. Last bit of data for you is a look at what kind of percentage interests go to the Indigenous equity side. And we've seen about 52% of projects have minority interests from Indigenous groups, whereas 48 are seeing either an equal 50-50 percentage, or 28% of projects are actually seeing a majority Indigenous equity interest in them. Again, this is probably reflective of the size of investments, and we do expect to see these trends move a little bit. Although there are lots of accounting and tax considerations that go into structuring these kinds of investments that do create some headwinds towards majority investments in some circumstances. So we will have to watch that more carefully. This data may not move quite as fast as some of the other data in terms of how Indigenous equity investments are structured. And with that, that's it for me, and I'll turn it back over to Lori.
Thanks. So tax is a very large landscape. I'm only going to talk about the tax exemptions under the Indian Act and the Income Tax Act. There are other tax exemptions available for GST, HST, certain provincial level taxes. I'm not going to address those. Next slide, please. So first, a word about nomenclature. The terms Indian and band are defined under the Indian Act. So when I use those terms, I'm using them in the legislative context of the Indian Act. When I refer to First Nation, I mean the political entities that are specific to Indians and bands. So the first exemption is for personal property of an Indian or a band that's on reserve. That's been interpreted by the courts to include wages. Sometimes the facts and circumstances are not very clear cut, so the courts have developed a connecting factors test. So they'll look at elements like the location of the employer, the location of the employee, where the income is earned, where the income is paid, and that will dictate whether the exemption is available. Now, this exemption tends to be narrow, but for Indigenous-owned businesses, it can be a boon for recruitment and retention of talent. Next slide, please. So the much broader exemption under the Income Tax Act is the one that applies to municipalities. So a city is not taxable. So for example, the city of Calgary has an externally managed investment portfolio. It has equities, bonds, money market funds, that kind of investment. It reported in its fiscal year end December 31, 2022, investment income of $142 million. So that's tax exempt. So we are on Tsuut'ina Nation territory right now, but through the lens of the Income Tax Act, we're in the boundaries of the municipality of Tsuut'ina. So that applies to bands, but also to other entities, and a determination can be sought from the Canada Revenue Agency as to whether the entity will qualify or not. So that is the first safe harbor. Municipalities might want to segregate their governance activities from their business operations, and they might want some protection from liability, so they might form corporations and subsidiaries. Those are also exempt from income, subject to an ownership test and a geographical boundaries test. So the municipality has to own or control 90% of the corporation, and no more than 10% of the income may be earned outside the boundaries. So using that investment example again, there's a reference here to a CRA interpretation. The question there was whether a municipality that had earned income through lending to and investing in corporations and entities outside of boundaries, whether it was still exempt from income. And the answer was yes, because the CRA will look to the situs of the income earning activities, such as administrative functions, management, etc. So again, this applies to bands under the Indian Act. Next slide, please. So that's the second safe harbor. There is a carve out to this geographical boundary restriction for municipalities in two circumstances. So the first is under an intergovernmental agreement that can be between different levels of government or between two municipalities or more municipalities. So we think here of transportation assets such as airports, ports, utilities. So that is also exempt if it's outside the boundary. And where the municipality is a producer or a distributor of energy or water. So, for example, NMAX Corporation is 100% owned by the City of Calgary. Its income is exempt from tax, even though some of its activity is outside the municipality and outside of Alberta even. There is a proxy for tax in Alberta and other provinces that's aimed at leveling the playing field with the private sector, payment in lieu of taxes. So that's something to be mindful of in that context. Next slide, please. So I'm going to talk a little bit about financing and do a sidebar here, because while First Nations and bands may be taxed as municipalities, they do not have the same borrowing power because of the paternalistic regime under the Indian Act. It's been around for more than 100 years. But first of all, some good news that came in the fall economic statement last night in this context. The Department of Finance promised, it announced that there would be a federal loan guarantee program of some sort implemented for Indigenous businesses. And we'll see in the next few slides why that's necessary under the Indian Act. And they also announced that low and no interest loans from government will not result in income inclusion. And they won't erode certain investment tax credits that might otherwise be available. There's been uncertainty over that for a couple of years because of a tax court and federal court of appeal decision that was attempted to appeal to the Supreme Court of Canada, and that was denied. So that was some very welcome clarity that was provided last night. So next slide. Just going to go through briefly the rules under the Indian Act because this question comes up a lot. So a reserve is actually land that's owned by the Crown. So can't be offered as security for a loan by way of a mortgage. Indian monies under the Indian Act includes some element of contribution from government. It can be the entire amount, the entire account, or there could be even just some commingling with government funds. That makes those funds Indian monies. So property that is deemed to be situated on the reserve includes any personal property, so personal property as opposed to real property, land. So personal property could include equipment, vehicles, other types of assets that might be used as collateral that has been purchased with Indian monies or has some element of government contribution to it. Next slide, please. So exemption from seizure, meaning can't be provided as security for a loan. So lands are exempt from seizure, personal property situated on a reserve, so it has some element of Indian money. It's deemed to be geolocated onto the reserve. And any contract that purports to transfer that exempt property is void from the outset. So you think of a general security agreement that includes like an all present and after acquired personal property clause that might include bank accounts and other assets. That's going to be void. That security won't work. Next slide, please. So there are some exceptions under the Indian Act. They're limited. Designated lands. Those are lands that have been conditionally surrendered with the permission of the Crown. So we think of leasehold lands, those can be pledged. Conditional sales contracts, so by law and under the agreement, the vendor keeps title to that property. And there is a waiver of rights concept under the Indian Act. However, it's not well tested in Canada. There isn't an Alberta case that I'm aware of. And that waiver has to be very explicit. So for these reasons, loan guarantee programs are necessary, from my perspective, to make the financing piece work. Next slide, please. So the template for what we're talking about in terms of like the tax treatment of a municipality, First Nation, and private sector player is really P3s, public-private partnerships. That's just another way to think of it, these large infrastructure projects. Partnerships tend to be the preferred vehicle for these types of projects. The threshold for partnership is low. It's two or more persons doing business in common with a view to profit. They're very flexible. The parties can agree to their terms, and there is no entity level taxation for a partnership like there is for a corporation. The income and losses are taxed in the first or calculated in the first instance at the partnership level, and then they're allocated out to the partners according to the terms of the agreement. So that allows for protection of the tax shield for the non-taxable partner without negatively impacting or having a neutral impact potentially on the taxable partner. Next slide, please. Limited. We're going to do questions at the end, okay? Thank you. So limited partnerships offer protection from liability, the same as a corporation. There are some specific tax rules that apply to those. You have to keep track of adjusted cost base, because when it goes negative, there's a capital gain, and the losses are tapped to the at-risk amount, which is basically the tax cost of the limited partner's interest. Next slide, please. So an example of where this might work in real life. So you have an owner, a business that has assets with a cost base of 50 million and a fair market value of 80 million. So there's an unrealized gain of 80 million. And the owner wants to sell or monetize half of those assets. So if the owner were to do that directly, they would realize a taxable capital gain of half that 30 million or 15 million. Instead, what the owner can do is roll those assets on a tax-deferred basis to the partnership and take back a combination of partnership units and a note. Then the new investor can come along, make the equity investment for the 40 million, and the partnership can then retire the note or repay the note to the owner, and there's no tax payable. Next slide, please. So this is just an example of what we might see with Indigenous equity, the type of structuring we see, just a little more complicated. So the owner might form a subsidiary to segregate its business, the project from its main business, roll the assets into that corporation, the subsidiary corporation, and then in turn roll them to the partnership, take back a note at both levels. And then the First Nation partner would obtain lending, a loan, and make the equity investment, and that those funds could be used to pay off the original owner. Now, in this example, I've got two general partners. So a general partner is responsible for the operations of the business of a limited partnership and has no protection from liability. So the governance general partner, for example, could be located on reserve. It could earn income through a management services agreement, for example. And if it has Indian persons as employees, they can be tax exempt. And if it has the right mix of ownership, like a 90-10 situation or something similar, then that entity itself would not be taxable. And Zach's going to talk a little bit more about governance. Next slide, please. So a special purpose vehicle might be formed for a specific project. So in this example, the First Nation in question is prohibited under the terms of a self-government agreement from directly carrying on business. It can indirectly earn business income, but it can't directly carry on business. And there are such agreements with the federal government. So in this project, a taxable entity was formed as the operator of the assets under a lease with the limited partnership. There's the owner of the assets. So the lease payments to the limited partner can be then, to the limited partnership can be paid to the limited partner, which is a trust. Now, a trust is a separate taxpayer under the Income Tax Act, but to the extent it pays or makes payable its income to beneficiaries, it gets a deduction. So in this scenario, the earnings from the lease payments are paid to the limited partner trust and then allocated to the First Nation and not taxable. Next slide, please. Just a couple of other tax considerations. A municipality can apply for effectively charitable status and get a authority to get on the list and get authority to issue charitable donation receipts. So in this slide there's a hyperlink to a list of municipalities or municipal bodies that have applied for and been granted that status. There are a number of First Nation entities on there. And over the last couple of years, there have been clean energy measures announced in draft form or implemented. So one of these is a clean electricity tax credit. It was announced in budget 2023. It's the Department of Finance has said it will apply to non-taxable entities, including Indigenous communities. I think they announced last night that that's going to be expanded to include biomass. So that's still on the table. We're still waiting for draft legislation in that area. And that is it for me. I'll turn it over to you, Zach. Thanks.
Thanks, Lori. So just to close out, we thought we would just take you through a few recent projects that the firm's been engaged with, our team, both in Vancouver, Calgary, and across the country. And just talk generally about some of the kind of key legal and commercial issues that come up on these deals before we open up for questions from the group. Next slide, please. So the first one to talk about is the Alberta Power Line. On this deal, Fasken, we acted for Quanta in the sale of the 500 kV DC line from Edmonton to Fort Mac. This was it's a provincially regulated line, and Fasken represented Quanta in the divestiture of its 20% interest in the project, which was sold concurrently with the Canadian Utilities Limited sale of its 80% interest. 60% of that APL entity, the partnership that owned the power line, was purchased by a consortium, including Greystone Managed Investments, which was doing business as TD Greystone Asset Management. And the remaining 40% of APL was purchased by 7 different Indigenous communities along the route of the project. Now, this transaction was completed through a competitive bid process. The transaction documents were developed by the vendors in advance and included a limited partnership structure that enabled Indigenous owners, purchasers to finance their equity either on their own or by piggybacking the financing of the non-Indigenous consortium. In this instance, the governance was set out such that a seat on the board of the GP, the governance GP, required a 10% interest. And nations could pool their interests in order to acquire essentially more seats based on the 10% threshold for each seat. Next slide, please. What's High? This is our Ontario office helped with this deal, which was essentially a power line project, series of power line projects spanning about 1,800 kilometers of transmission line in northwestern Ontario. This one involved partnership, again, a limited partnership between Fortis Inc. and a partnership of 24 First Nations, where Fortis owned 49% and the 24 nations equally held the remaining 51% through a limited partnership and had the ability to actually increase their ownership over time in anticipation of potentially coming up to 100% ownership of this project within a 25-year span after commercial operation. The equity financing for this First Nations Limited Partnership was provided by the provincial government of Ontario. We acted on for the province, advising them on that loan. It was a $1.3 billion loan to Watai Power to help finance that project. Next slide, please. The next one to talk about just briefly is RTI. So this was a Ridley Terminals Inc., formerly a coal port up in Prince Rupert, just on the coast of BC. Interesting transaction in that it involved both the privatization of a Crown Corp that operated the port, and then the divestiture of a 90% interest to a U.S. private equity firm, as well as the concurrent transfer of a 10% interest to the Coast Tsimshian, which is the collective entity of the Lax Kw'alaam and Metlakatla nations. In this transaction, like APL, it was done through a bid process whereby the prospective purchaser would step into the shoes of the documents, the shareholder agreement, the IBA, that had been negotiated in advance with the nations. And in that case, we were acting on behalf of a CDEV, on behalf of the Government of Canada. And that allowed essentially the parties to have sense in the diligence stage as to what they're walking into, but also have certainty for the nation as to what they were walking into as well. All right, next slide, please. On Tilbury LNG, this involves a suite of LNG projects we're working on in the lower mainland of British Columbia. We recently concluded a deal with the Musqueam Indian band. They're the claimant in the Sparrow decision, which proved fishing rights in the Fraser River. As a result of that, obviously have a strong claim to interest in and around the project where we are, and this is in Delta, BC, for those of you who are kind of trying to pinpoint on a map what we're talking about. But ultimately, this deal was structured essentially as an investment agreement like an IBA, but with the typical aspects you'd see in a joint venture arrangement like this, contemplating subsequent equity investments. Musqueam was granted options to invest in the projects through limited partnerships that would ultimately own each project. The key condition for exercising those options is consent to each of those projects at particular points in time once certain project milestones have been reached. And if and when Musqueam exercises its options that it acquires once it consents to the project, the overall ownership structure and basically the percentage and the quantity that the Musqueam would acquire in those project limited partnerships essentially gets set, and it's going to be subject to ultimately BCUC approval as part of the assets are provincially regulated by our energy regulator. Next slide, please. So Hydro One, we're acting for Hydro One currently on the equity participation partnership model that's been advanced throughout the province with respect to new transmission line projects with a capex of 100 mil or more. And interesting work there in the sense that, for those of you who don't know, Hydro One has made a corporate priority to say when those projects pass that threshold, each of those power lines, transmission projects, will have to be 50% owned by Indigenous communities. Linear projects mean lots of Indigenous communities in some circumstances. Fascinating from a commercial lawyer, Aboriginal law lawyer perspective. Tax issues come up as well. But ultimately, 6 projects on the slate right now, 5 in the south, 1 in the north. And like Tilbury, like the other LPs we're dealing with, those nations have the opportunity to invest as part of the limited partnerships that will subsequently own the project at key milestones in project development. Next slide, please. So just in the context of those projects across Canada, some of them dealing with, privatizing Crown Corp, some of them dealing with new builds, some of them dealing with brownfield or constructed projects where the project's been effectively de-risked from an approval perspective. There are some key terms and transaction issues that come up on these deals that we thought we would just touch on quick. But by no means is this all of the issues that come up or all of the terms that you'd want to keep in mind. The key ones we wanted to touch on were essentially issues around governance, management and control, distributions and dividends, ACCs or additional financial or capital contributions throughout the project life, exit rights, and what we call capacity development. Next slide, please. So a key point of negotiation that comes up in these deals concerns the rights of Indigenous owners to essentially have rights in respect of certain decision points along the way with respect to these projects. The first one is really the rights to appoint directors or officers to corporate boards, and that's both at the project co-level, but also at the Indigenous consortium level where a group of nations are coming in together. The key determining factors we see on this aspect of this type of governance right really is an Indigenous owner's percentage, essentially of their overall ownership allocation, directing how much of a say they will have with respect to appointing directors or officers in these circumstances. The second type of right that we see come up all the time is a right to appoint representatives to the management or other operating committees that will be structured once the entities are subsequently set up. And again, this will be key for scenarios where sometimes delegation of certain management authority will come related to the different operational matters that may be contemplated with respect to operation of a power line or a gas facility or whatever kind of project you're dealing with. The third type of right we're dealing with softly and see a lot of discussion on is rights to approve matters of material importance to the business of the project. And so while the scope of the approval rights are generally calibrated to reflect the size of the ownership stake, three common areas of approval rights within that kind of category for Indigenous owners typically relate to changes relating to the calculation or frequency of the dividend or the distribution, contributions or cash calls, and then fundamental changes to the business or the corporate or partnership actions, which would include things like dissolution. Now, the key point here is a lot of the, obviously these governance issues you can kind of distill into categories, but in the projects where you've got multiple nations, consortiums, groups coming together, the more often you see more nations, the more complex it gets along the way. And there's certain aspects of these structures that do find creative ways of dealing with that complexity. Pooling of interest, for example, with respect to seats on a GP, those kinds of aspects are common. Next slide, please. So with respect to distributions and dividends, this is obviously a key question during the due diligence phase of a project when nations are trying to figure out, what is the income stream that will actually be coming off the project, and for project owners, obviously, to structure how the relationship will need to look. The typical structure really is a base payment out of net revenue that can be subject to variations up or down, adjustments or deductions. And the structure that's ultimately chosen, we find, is obviously driven by the nature of the project you're dealing with. In respect of a larger regulated electricity transmission infrastructure project, the underlying revenue stream would typically be subject to variations when it comes to operations, maintenance expenses, insurance payments, and potentially holdbacks for different parts of the overall project lifecycle. In respect of oil and gas, you might see underlying revenue stream being subject to inherent variation, pursuant to terms of underlying transportation, tolling, terminaling, other sorts of agreements with customers, among other things. Next slide, please. So now, with respect to additional financial contributions throughout the project lifecycle, the extent to which project co-owners are required to make financial contributions once an entity is in place is obviously a key point of negotiation. There's a wide variety of approaches here around how this is handled. At a high level, the risk of oversimplifying, there's sort of three categories we're seeing the most. Essentially, Indigenous owners not being required to make additional capital contributions, either with respect to specific project risks or as a blanket cap going forward. We might see additional capital contributions from Indigenous co-owners being deferred or postponed to a defined date in the future, like for instance, after commercial operation date of a project, or a number of years after the commercial operation date has come in. And then the third category broadly is where you might see Indigenous co-owners essentially sharing ratably pro rata with capital calls other interest holders are going to have to make from time to time in accordance with the overall project governance model that you've agreed. Next slide, please. Now, exit rights. So a key issue, again, that comes up, and this is carefully negotiated for the implications it can have with respect both to the project, but also with respect to the remaining co-owners, is exit rights. The simplest approach we often see is a requirement that any owner looking to sell its interest must first get the approval of the other owners, obviously. But from there, it gets more complex and multifaceted, where other rights would be layered on. Could include some or all of rights of first refusal, rights of first offer, tag, piggybacking rights, drag rights, put and call rights, those kinds of things. Lockup periods are increasingly common as well, since in many cases, certainty as to having Indigenous partners is obviously a key driver for completing the transaction in the first place and often maintaining alignment over the long term. And project owners might propose that after a specific period of investment, Indigenous owners have to either hold their interest or can sell. But again, the key negotiated points here are, what's the duration of that lockup period and what are the exceptions, carve-outs to that. The last kind of critical factor to think about that we run into is essentially how those rights can impact your regulatory and other lending financing considerations, both in terms of the third-party consents that can get triggered if a nation decides to exercise its exit rights. Lenders may have requirements that get triggered. Financing may depend on it, the loan guarantee program, all the rest of it. You have to be thinking about that from the outset. Next slide, please. Capacity development. This is one of the issues that may not come up all the time for commercial lawyers, but it is often really quite integral to making these types of projects work, the transactions work, and being mindful of the interests on the other side of the table from you as well. You're acting for a proponent. Indigenous owners are often seeking covenants, can come up in the acquisition documents, it can come up in the government's documents regarding essentially opportunities to train members in relation to the business. Like, how do you run a pipeline? How do you manage and operate a power line? What does board governance look like? How do you act as a director in those scenarios? What's the responsibility of an officer? All those kinds of things. Intercultural training is also sought often, both from trying to make sure, obviously, you have a culturally safe workplace, but also making sure that, where you can, you've integrated Indigenous principles, concepts, protocols that are actually helpful to the business. And in that sense, we are seeing more nations expecting that meetings will be conducted potentially in a way that respects Indigenous protocol. Spaces are set out in a way that will respect Indigenous protocol and traditions. Finding ways of mutual alignment in those spaces can be helpful. It's important, last note, to obviously make clear there's no blanket expectation here, and it's really tailored to the expectation of your nation counterparty that you're dealing with or that you're acting for. But good to keep in mind what we flagged earlier, the whole principle of economic reconciliation, why we're doing what we're doing. Those types of considerations come in to essentially help facilitate long-term positive relationships. Next slide, please. Okay, so in terms of best practices and lessons learned, the first one is tax seminar. You got to talk to your tax advisors early on, and preferably without a rush, so you can give Lori the time to think through the issue. But honestly, talk to make sure your tax team is involved early, so you're not unwinding and trying to figure out how to fix a mess later. Governance is obviously critical, both from making sure that you've got something that can be financed, but also making sure it's something that can be valuable over time in terms of your project for potential resale to the market if you want to go that route. Anti-dilution protections, resale restrictions, all those kinds of things need to be structured very carefully. You need to be mindful about them, again, with a view to what your lenders are going to want to see, and also with respect to what a nation may need or may expect with respect to their protections in those circumstances. You have to structure your deal process to really account for the Indigenous equity steps, and that includes things like providing enough time and making sure the advisors are there to make sure nations who may not have run a project or a transaction like this can actually make an informed decision in a way that actually results in a project happening, a transaction closing, but that can take time. The loan guarantee program of the province you're dealing with may not be running at the same tempo you need it to, or that the project needs to, or the transaction needs to. So being mindful of that and building it into your closing agenda is key. And also, you got to take time, as you mentioned earlier, just to understand what the nations or nation you're dealing with is trying to accomplish. It may be that they want to be an owner because that's got symbolic importance, and they want to try and build prosperity for the future. It may be that this is an asset they didn't like, but will like if they're an owner of it. There's all kinds of ways to get these deals done, but you have to be thinking about what's the interest behind, the position your partner or your party is taking during the course of the negotiations. So with that, I think we're at question time. So all the hard tax questions, Lori gets. All the hard commercial questions Ron gets, and I'll facilitate.
Yeah, sounds good.
Sure.
Yeah, I think I had one earlier. So I think you mentioned that regarding low interest rate loans. So I think there was clarity last night with the economic forum that those wouldn't be considered government assistance.
Right.
Is that correct?
Yeah.
Yeah.
So do you want to repeat that? If you could just pause so Zach can repeat it. And
Sure.
So sorry, the government assistance
yeah.
loan guarantees.
I'll repeat that.
Sure, thank you.
I'll repeat that just because it's a tax
Sure.
question. So,
Excellent.
So the question is, the first part of the question is, the announcement last night gave assurance that the low interest and no interest loan programs, they would not be treated as government assistance under the Income Tax Act. Yes, that's my understanding from what I read. Yes. Was that the first part of the question or the full
Yeah,
question?
there's another one actually on the ITCs. So on the ITCs, I know clean energy
Yeah.
for tax exempt 15%.
Yeah.
Was there any clarity on if you had a taxable entity as a partner, would they access the clean energy ITCs at the higher rate?
You're testing me on
Yeah.
that one. I'd have to look that. So that was in last night. You think that was in last night? I'd have to check.
I know there was a question out there.
Yeah.
On, because I think if you're
Yeah.
taxable, you get ITCs at a higher rate.
Yeah.
If you're an exempt, you get it at a lower rate. So was there clarity if you had
Yeah.
partners, which one would you?
Yeah, so the question is with respect to investment tax credits and whether there was any clarification as to the rates that were going to be available as between a taxable partner and a tax exempt partner, whether there was any clarity provided on that. We have some tax big brains in the room here. Did anybody see that last night? Yeah, it came out yesterday, I think 2 p.m. Eastern, so I was, so Steve is saying that there's no mention of that last night. Yeah. Okay. Do you want to, there's some other questions.
Okay.
I have a question for Lori.
Yeah.
The structure that we saw earlier with the governance GP and the operator GP,
Yeah.
how common are you seeing that out there? How familiar are the banks and their counsel with it?
Okay,
it's not a typical limited partnership.
Yeah, so the question is a limited partnership with two general partners, a governance GP and an operations GP. How common is that? And for a financing perspective, how do the banks view that? And I think that's maybe a question that I'll give to Ron. Yeah.
So Steve, I think it's still a pretty novel structure. I don't think they're very familiar with it, but it's certainly legally, we do have a number of examples of limited partnerships where there are multiple GPs historically, not in this context, but in other contexts. It's a little bit of onboarding banks with the reasoning around this. And sometimes that crops up in a circumstance where you've got an existing asset, the owner has permits and approvals, holds permits and approvals for it, And rather than going through some of the brain damage of moving that into a new entity, you can convert the approvals holder into the general partner of the asset, leave the approvals there, it's the operator, but set up a separate governance structure through a separate GP as a means of bringing your partner into the room appropriately without having to deal with the transfers. And so we have seen that in a couple of circumstances, but I think it's still on the novel side. Zach, back to you.
Sure. Need a moving camera. I'm jumping up and down here. Maybe we should focus on tax questions again. A question for Lori. What are the tax implications if Indigenous groups are equity participants through a trust rather than a corporation?
Yeah, I think, thanks.
So these were some questions that came in separately. So I think I covered that in the structure, one of the slides. So a trust generally is a separate taxpayer, unlike a partnership. It's a taxpayer under the Income Tax Act in Canada. So generally, if it is allocating its incomes and gains to a beneficiary by paying them or making them payable to the beneficiary, those amounts retain their character for tax purposes, for example, as dividends or capital gains in the hands of the beneficiary, and the trust gets a tax deduction to the extent those amounts are paid out. And it is available. We have seen it with Indigenous equity participation, the use of a trust. Question? Sure. Go ahead.
Sure. We have a question about essentially an overview of different ways of structuring Aboriginal inputs into the project structure, and how Indigenous consent, or how can Indigenous consent be effectively monetized. So to put that differently, how do you get Aboriginal input into the project structuring process, and how can consent be monetized? Maybe I can take that one to Ron if you'd like to jump in as well. I think generally we have in the transactions we're dealing with, the projects we're dealing with in the IBA context, you've got a process where you're confirming the consent of the nation from an Aboriginal law perspective. Overtly on paper, and that is often most typically purposefully separate from the equity deal. So the limited partnership agreement or the shareholder agreement, whatever your arrangement is distinct from the consent arrangement. The equity, obviously, on the commercial side, being paid equity most often, obviously, whether that's financed by the nation or financed by a lender, but it's typically, or a carried interest, maybe if the nation and partner agree. But typically those are intended to be separate things for the purposes of the commercial arrangement.
Yeah, I think that's exactly right, Zach. And I think from my perspective, just to add to that, it's very important to keep those ideas separate, because at the end of the day, the Crown's duty to consult and address impacts to Aboriginal rights and title is going to exist notwithstanding the equity arrangement. So don't confuse the fact that doing an Indigenous equity deal somehow absolves the Crown of its obligation to consult. It still has to do that. Crown can delegate procedural aspects to the proponent, and so many proponents can assist in terms of getting the Crown to the point where it's comfortable that it's consulted and accommodated to the extent necessary, but that still has to occur, notwithstanding an Indigenous equity investment. There's certainly a better alignment of interests, including for the long term, especially when you're contemplating projects that might require going back out for re-permitting, expansions, potential changes to the project over time. Very helpful to have an Indigenous partner alongside for that road. But the IBA and the appropriate consent and approval from the nation up front to assist the Crown in terms of getting its house in order is also a critical aspect to it as well.
So,
Yeah, I had a question for you, Lori. You talked about personal property and real property in the Indian Act. Is there any distinction with intellectual property that you contemplated? Or?
Okay, so the question is a tough question. So the Indian Act differentiates between real property and personal property, at least in those sections that I was referring to in talking about security and the tax exemption. And is there a distinction that applies to intellectual property?
Is it treated differently than personal property?
Like whenever we're looking at whether property is real property or personal property in a tax context, it's, you often have to look to the case law that's specific to that area of practice. So, for example, if you're looking at whether something is taxable Canadian property, i.e. real estate, because it's part of a structure or facility, you have to look at, therefore there would be a withholding obligation if there's a non-resident. For example, you have to look at the law in the province for real estate in that example. So I think you'd have to look at the same question and look at the nature of the property in question, the intellectual property in question, to see whether under provincial law it was considered to be intellectual property. I think that's where you go, just off the top of my head. I'm not aware that it's specifically defined under the Indian Act. It's just an ancient piece of legislation. There may be some technical interpretations on it out there or some case law on it, but off the top of my head, that's the best answer I can give. Do you have any view on that? Anybody else in the room? Intellectual.
You register security interests in like copyrights and whatnot. We go to the federal offices, though, right?
Yeah. So next thing, if you're registering a security interest in intellectual property, you go to the federal office.
Oftentimes for trademarks.
Yeah, for trademarks and copyrights. Yeah.
Patents.
Yeah. Yeah.
So there's a mix.
So it crosses jurisdictions between federal and
personal property, then that would fall within the definition of personal property under the.
If it's personal property, I mean, you'd have to be okay. So you had a situation where you had personal property, and you wanted to take the position that there was a tax exemption. You'd want to be very sure. Do your research and look for any interpretation on that question in the tax world, but then. As Nick says, as a matter of federal law, right? Because I think that registration is under federal law and probably under provincial law as well. I don't know, we're sort of brainstorming here, I think, in the room on that question. Yes, you had a comment?
I've been doing this for a while.
Yeah.
If a patent, for instance, is personal property. And so there's a register someplace, but that just says every patent is owned. So if it's owned by a native person on reserve,
it's going to be personal property.
It's personal property. It's not exigible.
Yeah.
This is the subject matter. You may want to develop another seminar on this.
Add a slide.
In the U.S., there's similar things at play, such that if a patent is owned by a Indian band, unimpeachable. Like you can't even challenge patent in certain circumstances. Mm-hmm. So it's this opens up new vistas.
That's interesting. We can have a further conversation about that in the networking session. But your view, having been involved in this area for years, is that a patent would be personal property, in Canada or the U.S.
And in some cases, it's almost a bearer instrument, right?
And there's a bearer instrument. Okay.
There's something related to
Just
that.
real good.
Yeah, there's a good discussion. Good discussion here. Are there any other questions? Sure. Yeah. So we can have a discussion in the room here that the audience online or recorded is going to be left out of that, unfortunately. So I'll turn over to Zach to close.
Getting my squats in today. That's good. So thank you everyone for joining us. Appreciate you making the time to come out and visit us at Tsuut'ina Nation. If you didn't get a chance to fill in our survey, we would appreciate it if you took a chance to do that, as well as the folks online. And if you missed any of the other webinars in the 2023 Quarterly Perspectives on Tax Law series, you can check those out at the Fasken Institute section at fasken.com. So with that, thank you very much. Have a great afternoon.